Greetings from our team at Robare and Jones Wealth Management. This is Jack Jones, the managing partner, with our July monthly market update. Before I begin, I want to thank our clients for the trust and confidence that you place in us. The very best part of our day is time spent directly serving you. So we'll get started. First of all, we hope to see many of you next week at our quarterly investment forum over Perry's, where we'll be talking about all of these things in more detail. We expect over 100. So we're very much looking forward to that. As it relates to markets, the first half of the year, markets are sitting at the S&P at 5,600, near all-time highs. It is still true that the top of the market, specifically in mega cap tech, is driving the market. This is a look at the share of earnings growth over the last 12 months on these Max 7 companies compared to the rest of the S&P. And then the price return of those same Max 7 compared to the rest of the S&P. So one of the things that you look at is earnings growth commensurate with price gain. And in this case, this would say yes. Now, these stocks have been on a great run. The extent to which that will continue or there'll be some more rotation, we'll talk more about a little bit later. But again, what this shows is that 87% of the earnings growth, the S&P 500, were these 7 stocks. The remaining 13% was all the other S&P 500 companies. And that's kind of in line with the share of the price gain over the last 12 months. Now, we are seeing kind of a changing of the lanes of markets over the last roughly week. The Dow on Tuesday, July 16th, went up over 700 points. And the small cap index was up 3%. In fact, in the last week alone, the Russell has gone up 11, Dow up 4. The NASDAQ, which has dominated the markets the last 18 months, is basically flat over the same time period. So it's very short term, but we're seeing some signs with Dow and Russell 2000 of some changing of the lanes of market dominance. As it relates to jobs, the June jobs report was pretty mediocre, especially when you consider the revision. So 206 was the jobs added, but there were a negative 111,000 revisions. Unemployment rate went up to 4.1. Average hourly pay over the last 12 months is 3.9, which is the lowest since 2021. CPI came out month over month at negative 0.1 and a 12-month at 3. So that was better than markets were expecting, which means that we're now near 100% probability of a rate cut between now and September. So the odds of a rate cut went up dramatically with a better than expected recent CPI print. As it relates to the last raise to the first cut, 10.5 months is the average. We're now sitting at about 14, 15 months. So we're kind of overdue for this first rate cut after the last hike in the summer of 23. As it relates to the broader economy, the economy is weakening, but still growing. Last quarterly read at 1.4%. We know the consumer drives 70% of that. So let's take a look at how the consumer is doing. We have seen a pickup in debt service ratio, which measures the amount of household income that's tied directly to debt payments, just under 10%. Part of that is the fact that rates are higher, so it's taking more household income to service debt. We're also seeing delinquency, specifically in autos and credit cards, move up. So the consumer is showing some sign of weakness. Another sign of that weakness is that this peak savings, which peaked at 2.3 trillion, has now all but burned off, or at least most of it has. So that's another sign of possible weakness with the consumer. And yet another one is the fact that consumer credit card debt sits at over 1.3 trillion, and the savings rate is down. So again, the consumer, which drives 70% of the economy, is showing some signs of weakness that's worth us paying attention to. As it relates to earnings, in Q2, 81% of companies reported a positive earnings per share, and over half of those beat on the top line, which means on a revenue basis. Now, what that does mean is the PE ratio of the S&P, which says how expensive stocks are, sits at 21, which is above both the 5 and 10-year average. Another concerning sign is we sit at 121% in terms of budget deficits, which put us back to where we were in the Second World War. So our national debt, which is showing no sign of going down. In fact, it's showing signs of, as we go out another 30 years, going up. In fact, we're now spending over $1 trillion just to service the debt. So that's something to keep an eye on as well. Another interesting fact is what markets do once we're at peak money market assets. Those money market assets sit at a peak at 6.1 trillion as of the end of May. Other historical periods of time where money market assets have peaked, this shows the 3-year performance of both stocks and money markets after that period of time. So what this would indicate, all other things being equal, that a spike in money market assets historically means a good stock market performance over the 3 years that follow. So some reasons for optimism is that we don't get the long anticipated recession, that a soft landing happens. Inflation continues to moderate. The Fed does cut interest rates this year. We get a widening of market performance as evidenced by Dow and Russell 2000 recently. Earnings continues to be a good surprise, and we go through an election year where not necessarily outcome based, but that we get through it. Election years are typically good for the markets. So on the pessimistic side, we do get the long awaited recession in large measure because the consumer is weakening. And we get an inflation surprise where inflation doesn't continue to cool, but heats up, which means the Fed does not cut interest rates in 2024, and that's moved into 2025. Geopolitical risk is with us always. We've got wars in both the Middle East and in Europe. And events of last Saturday with the attempted assassination of candidate for president, President Trump, shows us that this risk is always something, even that we're not aware of, that could impact markets. Debt levels of the U.S. government is also a concern. Earnings could go both ways. They could both be surprises to the upside like they were in Q2, or they could soften. And an election year could just mean elevated levels of risk with uncertainty. We mentioned stocks in a presidential election year. The third quarter, which is the quarter that we're now in, is typically the best quarter in an election year going back to 1926. And overall election years tend to be better even than typical market years. So in non-election years, you're up 70% of the time. In election years, you're up 83% of the time. So overall election years tend to be good for the markets. So all of this is no substitute for contacting us about how all of these things apply to you directly. So please reach out to us if you have any questions about any of these items. We're here to serve you. So with that in mind, we'll close. Again, we want to thank you for the trust and confidence that you place in us. The very best part of our day is time spent directly serving you. Until we see you again, hopefully many of you next week at our quarterly investment forum, be well and take care.